Accounting principles, the fundamental elements of the worldview that governs everything we do in finance and accounting. Let me walk you through 7 core accounting principles. Conservatism, also known as prudence. Consistency. Full disclosure. Going concern. Matching. Materiality and objectivity. Using any of these terms knowledgeably in a conversation with finance and accounting people can help to get things done accurately and efficiently. For each accounting principle, let's discuss the main idea, the definition of the principle, and an example of how it can be used. Conservatism or prudence. The main idea is that it's better to be safe than sorry. According to the conservatism principle, all anticipated or probable losses are recorded as and when they occur, while anticipated profits are not recorded, but only when the profits are earned. Here's an example of how to apply this accounting principle. 2 recent payments to a supplier have been returned by the bank with the message "account unknown." Follow-up emails and phone calls to the supplier have remained unanswered. What should we do with the money? If we are unable to pay the supplier, should we record this as a gain? No, we shouldn't, at least not yet. According to the conservatism/prudence principle, we should keep the liability on the books. For example, this supplier could be in receivership, with a bankruptcy lawyer in the process of identifying all assets of the company in liquidation, including what is on their balance sheet, accounts receivable towards us. The consistency accounting principle. Achieving a high level of performance which does not vary greatly in quality over time. Transactions and valuation methods are treated the same way from year to year. Let's take an example related to depreciation. In year 1, all fixed assets of the company are depreciated based on the straight line method. In year 2, after careful review, the depreciation policy is changed for vehicles only. These are now depreciated based on mileage, which is deemed a more accurate and appropriate method. In year 3, the depreciation for vehicles is calculated to be very high, due to the high mileage. As the business doesn't really like the outcome of the calculation, can we switch back to straight line depreciation for vehicles? No. You can't just jump back and forth between different methods of recording significant transactions. You need to apply consistency of method, so the financial statements are comparable year over year. That doesn't mean you can never change your approach, but only when you have a solid reason to do so. Full disclosure. The truth, nothing but the truth, and the whole truth. All financial information regarding business transactions must be given in full. An example of the full disclosure accounting principle. Various lawsuits have been filed against the company regarding product quality. The company and outside legal counsel consider the lawsuits without merit. They believe there are no reasonable or factual grounds to support the underlying claim. Should we then simply ignore the lawsuits in the financial reporting? No. We need the truth, nothing but the truth, and the whole truth. It is important for users of the financial information to see the full picture. And for that, we need full disclosure. In the annual reports of publicly listed companies, the section called Commitments and Contingencies in the notes to the financial statements is actually one of the most interesting ones to find out what kind of trouble the company might be in. The going concern principle. The main idea, to be or not to be. Is this company alive and well? Is its heart beating at a steady pace? Or more formally, going concern means a business is financially stable and can operate with the expectation of indefinite existence, or at least for the foreseeable future. The opposite of going concern would be bankruptcy or foreclosure. Here's an example of testing for the going concern principle. What if a major customer has gone bankrupt, it's questionable whether outstanding accounts receivable will be paid, and it's unlikely that another customer of this size will be found. Can we assume the business operates as going concern and prepare the financial statements accordingly? That's a question that is not easy to answer. The company should probably disclose that there is substantial doubt about the entity's ability to continue as a going concern. The matching principle. What belongs where and when? Revenues and any related expenses, like cost of goods sold, are to be recognized together in the same reporting period, and/or expenses should be recorded during the period in which they are incurred. Here's an example of this accounting principle. The company pays a supplier upfront for a 2-year maintenance contract. Should we record the full invoice as expense in the current period? No. According to the matching principle, we expense 1/24th of the contract every month. And now for my personal favorite, the accounting principle of materiality. I've used this many times over the years in my defense. The main idea of materiality is that we are born to be awesome, not perfect. We try to avoid mistakes, yet they do occasionally happen. And some mistakes are more painful than others. Materiality is the threshold above which missing or incorrect information in financial statements is considered to impact the fair and accurate representation of the financial situation. An example of the materiality principle. $10,000 of expenses have been incorrectly recognized as cost of goods sold instead of selling general and administrative expenses. Does this impact the fair and accurate representation? First of all, at least the $10,000 is in the income statement and didn't accidentally end up on the balance sheet. Second, is classifying the amount in the wrong expense category material or not? That very much depends on the size of the company and its financials. Yes, it would be material for a company with $200,000 in revenue. No, it would not be material for a company with $2 billion in revenue. Objectivity. Verifiable facts versus subjective opinions or biases. According to this accounting principle, the accounting data should consistently stay accurate, be free of personal opinions, and be supported by independent and unbiased evidence. A real-life example. There is a rusty machine in the factory that hasn't operated in 3 years, but still has a value on the books. The plant manager says, well, it's a good machine that we will certainly use again. What should the finance director do? Keep the machine at its current value in the books? Once again, it depends. We certainly need a business plan. When can production be resumed? And what is the product margin? If we can't come up with a solid business plan based on realistic assumptions, then a write-off or asset impairment would be appropriate. Want to learn more about business, finance, accounting and investing? Then subscribe to the Finance Storyteller YouTube channel and start watching the next video in the recommendations on the screen. Thank you.